Hello everyone. In this video, we will talk about all the important details for taxation on stock transactions. I have divided the video into the following sections. Taxation of dividends. Within this, we will try to understand the difference between taxation on qualified dividends versus ordinary dividends, difference between realized and unrealized gains, taxation of realized gains. Within this, we will talk about the difference between taxation on short-term gains versus long-term gains, taxation on foreign stocks, tax benefit for realized losses. In the end, we will do a recap of what we learned. Some disclosures before we start. Even though I am a CPA licensed in the state of Texas, this video is for informational purposes only. This is not a tax advice. To the best of my knowledge, the information is current as of October 4th, 2025. If you see inaccuracies, please correct as needed in the comment section. Taxation on qualified dividends. Before we jump into the tax rates, let's try to understand what makes a dividend a qualified dividend. It should be a US or a foreign corporation that has a tax treaty with the US, and the stock should be held for greater than 60 days in the 121-day window starting 60 days from the dividend cutoff date. These are the two qualifications. The reason they are called qualified is once the qualifications are met, they are taxed at a reduced rate compared to your ordinary income like W2 income, rental income, etc. The exact tax rate depends on your tax filing status and your taxable income. For example, if your filing status is married filing jointly, you pay no taxes on qualified dividends if your taxable income is less than or equal to $96,700. You pay 15% taxes if your taxable income is more than $96,700 and less than $600,050. You pay 20% taxes if your taxable income is more than $600,050. Please note, these brackets change every year. These days, tax softwares are fully automated to update these brackets as they are released by the IRS. So you don't need to track manually. However, it is always a good idea to understand the concept. Taxation on ordinary dividends. Ordinary dividends, as the name suggests, are treated like your ordinary or regular income, like W2 income, rental income, etc. There is no special tax treatment or a reduced tax rate. Like regular income, the tax rate is based on your filing status and taxable income. For example, let's take the same married filing jointly scenario we had taken earlier for the qualified dividends. As you can see in the table, the tax rate ranges from 10% all the way up to 37%, depending on the total taxable income. These tax rates are much higher than what we saw for qualified dividends. As you will see in the rest of the slides, tax law incentivizes long-term holding. There are more tax benefits in doing long-term investments versus short-term investments. Realized versus unrealized gain. Let's try to understand the difference between realized and unrealized gain. If you see the slide, I have divided it into two sections. First section is unrealized and the second section is realized. Let's start with the unrealized. If you bought a stock at $100 and price today is $150, you are happy with the stock, you want to keep it, you're not planning on selling it. So even though you have a gain, it is called unrealized gain because you haven't sold the stock, you haven't received the money yet. So there is no tax in this scenario. Now let's move on to the realized section. For the same example, let's say you sold the stock. Because you receive $50, which is your gain, there will be a tax on this gain. Taxation on short-term gains. If you hold the stock for less than 1 year, the gain is taxed at ordinary tax rates. There is no special tax treatment or reduced tax rate. Like regular income, the tax rate is based on your filing status and taxable income. For example, if your tax filing status is married filing jointly, depending on your income, your tax rate can vary from 10% to 37%. As you see in the slide, based on the different income levels, the tax percentages vary like from 10% all the way to 37%. If you have held a stock for close to 1 year, it makes sense for you to wait few days or few weeks for it to complete 1 year. As you will see in the next slide, there are some advantages if you complete 1 year. Taxation on long-term gain. If you hold the stock for more than 1 year, the gain is taxed at a favorable tax rate. Like qualified dividends, it can be either 0%, 15%, or 20% based on your filing status and taxable income. For example, if your filing status is married filing jointly, you pay no taxes on long-term gains up to $96,700. You pay 15% taxes if if your taxable income is more than $96,700 and up to $600,050. You pay 20% taxes if your taxable income is more than $600,050. Taxation on foreign stocks. Most of the rules are similar to US stocks with the following key differences. When a dividend is paid, foreign tax will be withheld and you will get after-tax money. You must include the tax you paid to the foreign country in your tax return in order to get the tax credit. Otherwise, you will end up paying taxes twice, once in the foreign country and once more in the US when you file your tax return. If you want to avoid this complexity in your tax return, it is better to stay away from foreign stocks. However, there are some foreign stocks that have some tax treaty arrangements with the US which would allow a favorable tax rate. Please check with your brokerage firm before investing in foreign stocks. Tax benefit for realized losses. Up until now, we have only seen cases where we had the realized gain. Now let's consider realized loss. I know it's not pretty, but it does have some tax benefits. It can be used to offset gains. If there is still a negative balance left, it can be used to offset regular income up to a maximum of $3,000 per year. Let's try to understand with an example. Let's say you have a capital loss of $15,000. Your regular W-2 income is $100,000. Capital gain is $6,000. First, we offset the capital loss against the capital gain. Therefore, if we subtract the loss of $15,000 from the gain of $6,000, we are left with a loss of $9,000. Now, we can do another offset against the regular income. Please note, only a maximum of $3,000 per year is allowed. This is the maximum. So if we subtract $3,000 from $100,000, we are left with a taxable income of $97,000. As you can see, we were able to capture $9,000 out of $15,000 loss. So if you take a tax rate of 20%, this offset has saved us 20% of 9,000, which is $1,800 in taxes. The remaining $6,000 we could not capture can be carried forward to future years until they are fully captured. Now, let's do a recap of what we just learned. Taxation of dividends. We learned that there are two types of dividends: qualified dividends and ordinary dividends. Qualified dividends are taxed at a favorable or reduced tax rate, whereas ordinary dividends are taxed at a regular or a higher tax rate. Realized versus unrealized gain. We learned the difference between realized gain and unrealized gain. If you sold the stock, it is considered a realized gain. If you haven't sold the stock and you have a gain, it is considered a unrealized gain. Taxation of realized gain. We learned the difference between short-term gain and long-term gain and how it impacts the tax rate at which the gains are taxed. Taxation of foreign stocks. We learned how differently the taxation of foreign stocks work compared to the US stocks. Tax benefit for realized losses. We learned it could help reduce our tax liability. The uncaptured losses can be carried forward to future years until the losses are fully captured. If you found this video helpful, please like, subscribe, and share. Thank you.